Good morning, guys. This is Jay, smarthelping.com here. I've got a brand new financial model template. It's for startup buy now, pay later firms. So that means firms that offer oftentimes zero financing to merchants who can offer that to their customers, and the customers pay back the buy now, pay later firm. The buy now, pay later firm immediately pays the merchants up front, and there's a whole lot of dynamics in that in order to figure out how you can make money. I'm going to go through all the assumptions here. It's going to be extensive, it's in depth. I love the model. It came out great. I've built brand new logic that flows really nicely. Uh, so I'll go through each tab, explain how all the assumptions work. We'll have output, three statement modeling, executive summary, visuals, um, all sorts of things. And I want to start actually on the revenue tab because this is the most important where I can explain how things work. Then we'll kind of back up and go to software development, global control, and some of the other OPEX and loan facility areas, and then go to the details pro forma. So this model lets you scale out to three possible regions or merchant types. You could type the number of merchants you onboard each month here, monthly granularity, summaries of where you're at in total merchants at the end of each year, as well as the growth of that. Um, and then for each merchant, we have assumptions. And so let's think about this. So you onboard a merchant, and here's what we can model about the merchant. We can say what's their expected starting annual sales, what's their expected growth rate, what's their average order value, what's their average annual growth in order value, what's your merchant fee. So this is the primary way that you make money as a buy now pay later. And then are you also possibly charging a fee for every transaction? Now, let's talk about these for a little bit. So the annual sales is dynamic and it starts during the tenure of whenever the merchant is onboarded. So if this is 6 million, then even, if you sign up a merchant in year 24 or month 24, they're going to start with 6 million in sales. And then this growth rate will apply dynamically to that. So that gives you a nice baseline to say, okay, when we sign on a merchant, we're looking for somewhere around, these sales levels to start, and then we think they'll grow based on these different percentages with these different order values. So that's really nice. And you could see here, if we go to the M1 tab, we could do merchant sales here, and you can see every time they start, based on the assumptions for tier 1, they're starting at that same amount and then growing their sales every 12 months. So even if I go down here, see we're starting at 2.5, and then on average in the next year we're growing based on whatever the growth rate is. And that applies the same for tier 1, 2, and 3. So the reason why we need to know that is we're going to capture some of those annual sales with, buy now, pay later software that lets customers use that. They get the product they want. They don't have to pay anything up front, or maybe they pay a little bit up front and then they pay it off over time. And the the way the fee works here with most of these is let's say the customer buys a $100 product. What that happens is the buy now pay later firm will send, if the fee is 6%, then the buy now pay later sends $94 of that to the merchant immediately, so the merchant gets the money, and then the customer pays back the full $100 to the buy now pay later firm. And remember, there could be fees as far as late payment fees. There could also be promotional interest, meaning that some percentage of customers might not pay the balance off in full on time. So if let's say it's a promotional 12-month interest free, but if you don't pay off the full balance in 12 months, then you're going to be charged some kind of interest accrual during that time. So we can account for that here. And note this percentage is not an annual rate. This is just saying relative to the initial purchase price, what's the total interest charged to those that end up not paying off the balance at the end of the term. So this is kind of like a multiple of the sales price, and it's just a lump sum. You could do some calculation to figure out what that might be based on compounding interest and different interest rates, but for the model's purpose, we just wanted to know the total amount of promotional interest charged for customers that don't fully repay in the period, if relevant. If not relevant, you can always zero any of these out. We also have a month delay for how long it takes to collect that interest if they are late. Um, we also, so if we go up back up here, so we kind of talked about this. The other late fees, you've got a late payment rate, so a percentage of all the customer payments that are late, what that fee is for those payments that are late, and then some of those customers might default, meaning they'll never pay, so you don't want to count those as well. So 30% of those, in this case, are not counted. And notice how I put all of the assumptions over here to the right. So as you adjust these things, you can see how it changes. Like, let's say these merchants were averaging 3 million instead of 6. You see the numbers are going to go down. My ending cash is 96 million. Now it's, oh, we added too many zeros. Sorry, now it's 27 million. You can see net operating income, your revenues from each tier, direct costs, minimum cash required. This is a big one. How much you need to from investors or owners. The IRR of the project, investors and operators, cash flow per period, and based on how you recognize revenue, this is not actually how much cash you have coming in, because remember, the moment you pay the merchant is when you actually recognize revenue, but you're collecting that as a receivable from the customer over time. So we have customer collections and merchant payments here to show the actual change in cash each period. And you'll see these terms here, the average installment period, is going to dramatically affect the minimum cash you need. It's going to dramatically affect how much of your credit facility you're going to need if you're going to borrow money to pay. When you have to pay that merchant up front, you're going to need a lot of cash flow up front to do that, to make those merchant payments. Depending on how long it takes you to collect money from the customer, there's going to be a big swing there in how much cash you need in the interest expense. And note on interest, we'll get into this more, but you can define how much of the merchant upfront payment that you got to send to them is going to be financed with a credit facility, and this also, and you can see how that affects the cash balance over time here. We'll get into that a little bit more later. And we have the interest coverage here based on net operating income. Okay. Oh, I forgot about this. There's also seasonality, which is in relation to the merchant sales, which could be very important for scaling. You want to know, on average, when does this annual revenue from a given merchant come in during the year? If it's dramatically, different in one month to the next, and you could define that, and that all applies dynamically as well. And that could have a big impact on the minimum cash requirement, especially again when you have these terms, and it can affect the cash you need a lot. And I was playing with some of the numbers, and you'll see when you do it. You know, and just looking at the term here, watch what happened when I put this from 12 to 6 months. You'll see how this minimum cash requirement changes from 25 million down to 3.6 million, and that's just reducing the term from 12 months to 6 months. And why? Because when you have to pay the merchant up front, but you're waiting 12 months for the customer to pay back, that dramatically increases the amount of money you need to get the operation going. Um, see, the ending cash is actually affected almost just as much as that initial minimum cash, and note we are counting an exit as well. So you can see it's just really, this is probably the biggest variable. Obviously, the merchant fee is a big one as well, how much you're collecting. But this is going to affect cash flow the most, in my opinion. Defaults has a decent effect on the exit year because if you have a lower default rate in year 5, you're going to get a nice boost to net operating income, and the multiple is going to apply there. For example, if I go from 2 to 1% in year 5, watch how this ending cash position changes from 27 million, 4 million difference there. But on the other years, like if I did it for year 4, it's barely a difference. Was that 27.9 to 27.6, 300,000. But you can, and the reason why these are going down is the assumption is that you'll have better credit underwriting and lower your default rate over time. But you can model this however you see fit for your scenario. Okay, so we did merchant revenues, we did late fees. Here's the buy now, pay later penetration rate. So this says of all of the revenue that the merchant's getting, how much of that revenue is going through the buy now, pay later system. So we can start off with maybe a lower percentage, and then maybe there's some monthly growth rate here. This is not a growth rate really, it's just a increase in this percentage. So in month 1, you get 10%, month 2 it'd be 11, and 12, and so on, and it go up by 1% per month until we reach this stabilized rate. And that's saying that at some point you think it's likely you're not going to have much more capture of the merchant sales at whatever this is. And again, this will be something you figure out with data and testing, but you really want to be able to model a penetration rate that changes over time as you onboard merchants. And this rate also applies dynamically. So a merchant onboarded in month 30 is going to start at 10% and then start moving in this pattern. And this is one reason why the matrix tab here was so complicated, because you have to have a couple layers of references. So you've got to have merchant sales dynamically going up, and then those are changing over time. And then you have the capture of those sales changing over time for each merchant tranche or each merchant cohort. And then you've also got this whole thing with defaults and recoveries, and you've also got to figure out how much of the money, how much of the funding amount that you're funding for the merchant into the customer is getting paid back over time. And that's all dynamic as well, based on these repayment schedules, based on the installments, how much is paid up front. So there's a lot of logic I had to go through to make all that work correctly to give the user the best flexibility in the model and really get accurate assumptions. Okay, so penetration rate, then we've got percentage of customers who don't pay in full on time, and this is just a promotional interest, so some percentage of all customers don't pay in full, and there's a penalty rate for that and the monthly delay to collect. And this 65% is always applied to the initial funding amount. So it'll be that amount times this amount of customers, and then the 2-month delay. So you can see that happening here. Promotional interest charges. Here the first one happens in April, and we're taking the age. So again, the age we can figure out based on the term, the age of the customer, and then this delay, we know when the last month is, when we would collect that relative to the actual beginning for those customer cohorts. And you can see just by me explaining that, you can tell how complex these calculations are, and it is a little mind-bending. It took me a while to go through and just make sure everything's working and it flows correctly. But everything's got a nice reference, and it all flows very, very good. So there's that. Defaults I went through, and then we have default recovery. Now defaults, I really want to explain how nice this works. So We can say some amount of customers will stop paying at some point. You can define on average the month that the customer will stop paying. You can also define the percentage of those non-payments that get recovered and how long those payments take to get recovered. So this is a really nice way to calculate defaults because we can actually, since we have the references of the timeline of customers, we can say, okay, if it's in this case, let's just look at a 12-month term. So the customers have 12 months to pay back. They pay 10% up front, which is going to count as month one, and then they pay whatever the remaining, I believe this is a calculation, 8.2% per month until the term is over. So then you're at and if you say that typically the defaulters stop paid in month 4, that means you're still collecting month 1, 2, and 3 from them, and then month 4 to 12 is 0. And that month 4 to 12 is your default amount. And then that is also the basis for how much you can recollect based on the recovery rate. So that was a really good way it makes sense. It's not too broad of a percentage. It's very specific in how it works. And you can see here, we have the total defaulted amount for each cohort of payments and the recovery of that happening over time based on how many months it takes to recover. You've also got to know the age of the recovery to do that. But here in this case, in tier 1, there's just, we basically are saying average of 2-month installments, and if they typically stop paying in month 2, well, they're paying in half of it, and the other half they're not paying, so it's just 1 month. If I were to extend this to, say, 5 months, you can see now the defaulted amount for each period, it's still, so this amount would be let me see. So if we go not collected, here's the amounts not collected. But we have to roll that up into a total per month of not collected for tier 1, and then that's going to flow to here to figure out how much was actually defaulted for each monthly cohort. And those have to stack because, for example, if this is 5 months and they stop paying in month 2, okay, so they pay in month 1, they stop in month 2, 3, 4, and 5. So that's dynamic. If I were to put this to 4 months, you now would have 1 month paid and 3 month default. So you see that change there. Okay. So those are defaults. Let me put this back to 2. And then next on this tab, the last thing is variable cost. So here there's some volume-based fees. So this is just how much you're paying for payment processing potentially. This is when customers pay you back. There might be an interchange fee that costs you. There could be a per transaction fee. I also did a credit risk and assessment fee, which applies to each new customer once, and a regulatory and compliance fee, which applies to each customer payment. So there's cost per payment, there's cost per new customer. These are on payment volume and per transaction for payments here. And you can see the volume-based fees the most. So look at our ending cash at 27.6. If we zero this out, we're up to 31, 33, 35 million. So that's probably the biggest impact. All these other ones together probably wouldn't even have that much of an impact if I zeroed all these out. Yes, still, I mean, it's a couple 100,000 over. I don't know, it gets to into the millions, 29, if you zero out everything. But this first one's going to be the biggest impact, and then these are next. Now, it also depends on the transaction volume, your average order value, how that changes can affect the number of payments and these costs as well. Okay, so that's everything we have to do with revenue generation and some direct costs. Let's go back to the models start. So global control here, these are just a couple high-level assumptions: company name, You can run the forecast for up to 60 months. You could define that. It doesn't have to be a full 5 year. You can adjust this to any number up to 60. You can choose to include a terminal value or not. If yes, you can do a multiple. And then the first month of the forecast, this is essentially just relevant for the seasonality because we need to know on a given month what month is it so we know how much percentage of the given merchant's revenue is coming in. That's all that applies to. It doesn't affect anything else. And then you've got some tax rates here to tax corporate income tax if you have profits. All these other things, cash sources, investors' equity, owners' equity, all come from other tabs, which I will discuss. Executive summary, high level view of all the different line items, kind of like what you see on that revenue here, similar, but we have a couple of visuals as well. Equity multiple, ROI, IRR, software development. So this is your initial costs, which these are intangible things that are amortized, meaning you get to recognize this cost over time in the income statement, which is just a taxable thing. It has nothing to do with the actual cash flow. The cash flow happens based on how much the cost was and the percentage you put on here. And then that will drive up fixed assets, and then you can depreciate that based on the CapEx schedule here, based on whatever useful life you assign, and then the start month of depreciation. Software costs are usually depreciated, and sometimes they could be in cost of goods sold. Here I'm just putting it in below the line for regular depreciation expense, not a cost of goods sold, and it obviously hits cash flow based on this schedule here. Revenue we went through. Tabs M1, 2, and 3 are all where the dynamic calculations are happening. OPEX, here we can define just some fixed operating costs, sales and marketing, the start month, the annualized cost, the change in that over time. G&A, R&D, same deal. Other costs as a function of total monthly revenue, and then other direct fixed costs that would be considered cost of goods sold, their start month and annualized amount. Then we have CapEx I went through, FTEs, full-time employees. So this is where you might want to spend some time. So the top section is just a cost type, the start month, the count of potential different salaried employees, their average salary here, and then what changes over time as well as payroll tax and benefits. Now the bottom part is dynamic and scales with transaction volume, or essentially monthly orders. So here you can say how many of these different personnel, up to 5 types, do you need per monthly order. So if you put, in this case I put 0.0001, that means for every 10,000 orders you need 1 of this type of personnel, and here's their salary, payroll tax and benefits, and annual increase in salary. Okay, so and I did 5 types, so this could be customer support, it could be sales reps, just whatever you want to scale with your monthly order volume. So that's important because the reason why I put this in is otherwise you'd be going over to either up here or in the OPEX trying to figure out how you're scaling customer support as you get to potentially hundreds of thousands of customer payments you got to process and orders. You need some kind of support staff there, so and you don't have to manually figure it out. You can do it based on these ratios for up to 5 types. So I thought that was nice. Next up, we have credit facility. So the credit facility is quite important, and it's going to affect cash flow requirements quite a bit. So let's say we put this at 100%. That means all of the merchant payments we send out, we're going to fund. So you see how quickly the cash balance goes up and the minimum equity required goes down. Here in this case, we are at 6.9 million already from just those couple months, whereas before when we were at 10%, we're at 25 million. So you're gonna borrow some percentage of the merchant payments that you got to send out. You have to pay interest on this, obviously, over time, which is going to be here. And then at some point, at the end of the forecast, you got to pay back whatever the balance is on that. You can also do manual repayments here. So let's say you do, you don't want a huge upfront cost. You're going to try to finance a lot of these upfront with debt. And then as your cash balance then starts to grow as you operate, you may want to pay it down. Let's do this for a little bit longer. Okay, yeah, now you're at 69 million, so maybe you want to pay off some of this balance. It's at 70 million. Maybe I want to pay off 50 million worth, and that would decrease. Obviously, your interest expense goes from what 500,000 a month down to 250, 260, and then that affects your cash flow as well. We went from 61 million to 19 million. So this is pulling from the monthly detail. This is proceeds hitting cash, positive cash, interest reduces cash, and then you can also pay extra here. And then the principal amount paid back on exit, if you're including the exit value, is still going to be correct, whatever the remaining balance is here. So it's a great way to manage cash, and I thought it's important to be able to adjust this percentage each month. It was too strict of doing it like one percentage that applies to every period. I think this needed to be able to be adjusted over time as your cash flow changes. So I just have a strict 10% to start here, just a default number. You can define the interest rate, the interest only period. Now for models where you're not really trying to pay anything back early, I just put any number in here above 60 because the model only goes to 60 months. So if you just put this up here, it just runs until the forecast is out and then pays back the balance. We're not switching to amortization, but you could, if you wanted, you could say, okay, I want to run an interest-only period for, say, 24 months, and then I want to switch to a amortized loan and not take out any more money. You could model that as well if you want. But mostly this will just be used as an interest-only credit facility where you borrow, you pay it back as you get cash flow, and there'll be some interest expense. And again, this is integral to figuring out how much leverage you want to take on, how much cash you're going to need based on all these different activities. And I think I was super happy with the way this turned out and what kind of flexibility and adjustment you can pull and what leverage you can pull as your revenue assumptions and funding requirements change. You can get a sense of, and that's why we have the interest coverage here to figure out, how much money are we making against the amount of interest we have to pay. Now, keep in mind this. I don't know. So I was thinking about different ways to do this. So this actually includes the NOI includes this interest cost, but we're also saying, okay, what's so in also this is not recognized revenue is not cash in, but in theory, this is the amount of net operating income you're actually generating. As if you zeroed everything out, you got all the money from the customers that the customers owed you, you paid everything out. Like that's like the amount of profit you have. So I just use that as a basis for the interest coverage. At the end of the day, though, you can look at each on the monthly detail right here. This is going to show you negative or positive what the cash flow is doing based on everything happening, interest, all the operations, customer payments, default, like everything. So that's the most important number there, and how much you actually need to get through the period. Okay, so that was credit facility. We also have loan 2 and 3. These are like working capital loans, or just they're simple amortization schedules. You can put in some financed amount and some draw month number here, and it just flows through accordingly. Cap table, this is where your minimum equity required, which in this case is now 6.6 million. let me go back here to credit facility. I think it's because I zeroed out this halfway through the forecast before. So our equity requirement was higher. Let me do that again and see. Yeah, 34 million. Let's try to get that down. And actually, I want to put the minimum. This is a good thing to have up here. Min equity. Just a quick calculation so you don't have to try to look through this whole thing. There it is. Okay. So let's say we do a couple more months, get that to 20, back to 27 or so, 26. Okay. So there's our minimum equity required, 26 million. You could put who those funds are going to come from between outside investors and operators. The total in this from rows 11 to 30 in column C and C35 to C54 should add up to this total. I have a filler here, so essentially any money you put in these other boxes that does not add up to the total, that remainder will go in here. And then you assign them. Usually people just use the common stock, so you just put the percentage of the company you're giving to each entity that's contributing. And your founders and stuff might not contribute that much, but they should have obviously a larger share. I've just put in arbitrary numbers. The point is you want to make sure these percentages from rows 11 to 30 plus from 35 to 54 when added together should add up to 100%. So here we have 95% to investors, 5% to owners. Now this could also be 80% here and 20%. And you can see the cash flows, distributions available. Here, this is actually a 5-year forecast. We don't need all those other up to 10. And the resulting IRR of each, and that's going to change as the percentage ownership changes as well as the contribution amount. So you can play with all those different numbers here. Startup costs, just some other one-time initial costs that you want to account for that you haven't accounted for anywhere else. Those will hit in period 0 and affect your cash requirement. Terminal value is just a summary of your multiple, the 12-month trailing EBITDA, what the value is. Usually I just keep this at 100%, but you can put it lower and apply some of this to your CapEx items, and there'll be your capital gains taxes applied accordingly if there's a gain there. Monthly detail, this is where you see all the nuts and bolts of all your assumptions coming together. So here's everything that's happening with Tier 1. Sorry, let me undo that. So Tier 1, 2, and 3, consolidated, your direct costs, gross profit, sales and marketing, G&A, staffing, net operating income, loan proceeds, principal interest. And remember, this credit facility amount, this interest here is hitting above gross profit because it's considered a direct cost. Usually that will be the amount of money, you directly need that to make the payments to the merchant. So that's considered cost of goods sold or cost of sales essentially. So we don't want to double count it. So we have it up there. It's shown here as a reference, but it's not actually calculated in cash flow. If you see here, we leave that one out, but we add it in when we go direct costs. It's included in this section. Then CapEx, taxes, exit proceeds, and cash flow. And then that's everything. That's your monthly detail. You can hide or unhide the side to kind of make it more consolidated to see everything. Annual detail does the same thing, but on an annual basis. Discounted cash flow analysis, you can see the initial amount needed, and then distributions available over the 5-year period, internal rate of return, chart. We have some visuals here. Revenue, gross profit, year-end accounts receivable, and this is again what your customers owe you. Cash flow, gross profit, net operating income, annual revenue by type, EBITDA percentage, monthly transactions facilitated, annual CapEx, debt service coverage, total merchants by type, assets versus liabilities monthly, monthly cumulative cash flow, and then assets versus liabilities annual. Note this cash flow is going down. That's because it's taking more and more money based on this. It's this 12-month term here that's making it. So as you add more merchants and they do more, you're continually having to pay that merchant fee up front. So you're making money. Your net operating income is positive here, but because it costs so much to fund that, um, you are cash flow negative. And again, based on how much, what percentage you're financing against your interest expense as well. But the exit is still, it's going to take what your net operating income is as a multiple. So we're getting 97 million at exit, which is still a positive number. And you'll see if we go over to, we've got the income statement here, the balance sheet at the end of the 60th month, we have 73 million in receivables, which is, hey, the customers owe that money and they'll pay it within the next 12 months at the latest because we have 12-month terms. So that is an asset. So that would go into, but you can see here our minimum cash position is actually happening in month 59. Now, if I were to change some of the assumptions, that could dramatically shift. For example, let's say instead of doing 12-month terms, I'm doing 6-month terms. Okay, and then if we look at our credit facility, it's actually a good way to see it. So we're still going negative. We slightly get positive here in the last 2 months. If we go back to the balance sheet and go, you see our zero out happens month 51 now instead of month 58 or 9 or wherever that was. So this is essentially when we start the assumptions are so that we end up actually producing positive cash flows, not profit, which is different. We've been making profit, every year is profitable, but cash flow and profit are different in this type of a business model with the buy now, pay later. You can see the actual cash flow happening here, and once we stop borrowing money, we start to go negative again for a bit, and then what's that, month 51? There we actually start to go positive on the cash flow basis. So that's a good spot to be, and then obviously we keep growing. You could exit whatever you're trying to plan out, but it's a very very I had the most fun and it was the most satisfying playing with these assumptions because you really could see a difference in cash flow and strategic planning. And I'm just playing with arbitrary numbers. You go in and put your own inputs into here, but I could really see a difference and see how the trajectory of the business changes based on changing these different assumptions here. Okay, I'm going to put this back to 12. And let's see, what else did I change? Just seeing if I adjusted any of these other variables before we started the video. It doesn't really matter. Put this to 6% as well. This percentage paid up front, to remember, is also important. And it could be more than just, if it's 12 months, you might do 1/12 for the percentage, and that just means it's just even 12 payments. But you could also require more balance paid up front for the longer term. Maybe we say, okay, well, customer, you got to pay 20% up front, and the remaining 80% you can pay over 11 months. And that'll affect your cash flow accordingly. And in that case, we're at 19 million min. So yeah, it's $6 million difference just by that adjustment. So I hope this becomes useful. I think it's a insanely valuable template. If you want to download it, it's going to be over at smarthelping.com. We're going to list it in the general industry bundle. It'll be a one-time fee. You can buy it for $75. That's the pricing point I'm going to come in at. Or you could buy the whole bundle here for $2.99 and get it in this. It'll also be included in the SaaS subscription tech. I have some tech, data centers in here, EV charging stations. So I think even though it's not directly it's software, it's kind of as a service, but it's more of it's more of technology. But I think I want to put it in the SaaS bundle as well. So it'll be included in here. It'll also be in the Super Smart bundle. Obviously, that's every template on the whole site for $4.99. And then remember, guys, if you want to hire me, my rate's $275 an hour, and I could go and work with you on your own business model and build a financial model template like you just saw today into your exact specs. Usually I have pretty quick turnarounds. I try to burn off my billables as fast as possible, so I'm available. I usually have pretty good availability on that. Okay, well, like and subscribe. That's all I got for you, and we'll see you on the next one.